October has been brutally red for the market so far, which honestly isn't surprising when you remember it's historically the most volatile month since 1945. But before we start to panic, let's zoom out. Year to date, a lot of stocks are up double digit. Having said that though, investor sentiment has flipped hard. We're bouncing between fear and extreme fear, and with valuations flashing red above long-term averages for months now, it's no shock that cracks are in fact starting to show. But here's the thing, not every stock is stretched. In fact, some are crashing down towards their 52-week lows right now, and we're breaking down 7 of those stocks that are getting hammered to figure out whether or not they're a buy, hold, or straight up avoid. So let's dive in with stock number 1. We have T-Mobile US. It's up 3% over the last year. Year to date, it's also up, but around 4%, and it's trading near its 52-week lows, quite a pullback from its 52-week highs. If we look at the last 10 years, well, this one has significantly outperformed the S&P, up more than 463%. Now, each one of these companies, we're going to give you our own valuation as well. And in fact, Seeking Alpha, Wall Street, and Quant, each one of them give this a buy rating, something that is fairly rare to see on the channel. And if we look at their forward P, well, it does sit at 20, which is below their average of 22.6. This straight away tells us potentially undervalued, although bear in mind, we don't look at this in isolation. The other thing to note here is the yield on offer today, 1.8, also sits above the historical 1.6, another reinforcement of undervaluation. And then we get to the blue tunnel, which in fact for newer viewers highlights the intrinsic or expected price when we note it sits within. As of today though, TMUS is sitting just below, so another third confirmation of undervaluation. Although we would pinpoint that over the last year, this one has been trading at a discount overall. And if we were to zoom out to the last 5 years, well, this one actually since 2023 has been trading severely undervalued. At the same time, and this is key, the intrinsic price has been increasing, which is where we would always say it could be a great opportunity. Prior to that, it was trading at a premium, so maybe one to consider. And if we look at the valuation grade, they do get a D, trading at a 54% premium to the sector, although as we highlighted, at a discount to their 5-year average. We'll also incorporate the PG for those that want to see. 1.5 currently, pretty much in line with the sector overall, but actually historically it has traded lower, so on a PG ratio for TMUS you're paying a 14% premium. And then finally, before our own valuation, institutions hold 42% ownership. They sold 12 billion in the last 12 months. Same time frame, they did buy a little bit more, and we can also see that in Q3, the latest data set. If you wanted to go back to where there was the reversal, more selling than buying, you'd have to go Q3 2023. So more often than not, institutions, at least over the last few years, have been net buyers of T-Mobile. And as we said, each one of these our own valuation process, where for TMUS, $287. That is derived from the DCF model, which as always, you can grab a copy by clicking on the pinned comment below, running through your own numbers, whether for this company or any others. First thing we'll draw your attention to is on a reverse DCF, 7.7% is already baked in to the future growth. This is always a great starting point because if you believe this is too high, already you can put this down as overvalued. Vice versa, if you believe this is too low, it'll grow at a faster rate, potential undervaluation. Now we've gone for 10% as we typically do, using the middle rate as a starting point. Incorporating the discount rate gives us the present value of future free cash flow and terminal price. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, giving 25% upside from an intrinsic price of 287. Now, full transparency, at 8%, you can note 236, still upside, but very minimal of 3. And for those a lot more bullish for the growth, 12%, 345, 51% upside. Now, we're not done because we do take the middle rate to understand what is the margin of safety, and we typically kick off with 10%, execute buy if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, we'll buy at $258, but what we can note, if you're adding at the price, you're getting a 20% margin of safety today. For those that want to make a note of 25%, well, it would be a buy at 215. Wall Street see 23% upside into next year, and all of the stocks we're covering today are in fact around this level, if not higher, into the 30%. 282 is their target price. So let us know on stock number 1, TMUS, but we can also highlight on the other occasion, if you believe 8% to be more appropriate, you are getting a trivial MOS of 3%, and if you believe we should be more optimistic at the higher end, you're getting a 34% margin of safety. So let us know your views on stock number 1 today. Before we continue, we want to let you know we are releasing our latest free weekly article this morning. As always, we drop one every single Sunday morning to your inbox, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is Waste Connections. Now, we've covered waste management not too long ago, pretty much similar industry, where it is down 5% in the last year. Year to date, pretty much flat. Over the last 10 years, like we just noted from stock number 1, massive outperformance, trading pretty much at its 52-week low, pullback from 52-week highs, and we notice not only a buy from Seeking Alpha and Wall Street, but 4.44, very close for Wall Street, flipping this into the 4.5 strong buy. Notably, very rare as well to see Quant giving it a sell. Now, forward valuation of 32 does sit below the historical of 35, so straight away potentially undervalued. Couple that with the blue tunnel where it does sit right towards the bottom, something we haven't noted or fairly rarely in the last year, but also it hasn't entered below, also tells us the market doesn't discount this one, at least in the shorter term. And when we zoom out to the last 5 years, message is very clear. This one only really entered into an undervalued signal at the end of 2023. Otherwise, this one pretty much trading either at a small premium or at a reasonable signal. Something that is confirmed again when we stretch over the last 10 years. Market does believe Waste Connections is a high quality company, and the grading does get a D-, 61% premium to the sector, but as always, sector does include some very poor quality companies. Against their own 5-year average, we pinpointed a small discount. In terms of price to earnings growth, well, it does sit around 3, above the sector, but pretty much in line for what they do trade at on this ratio. And institutions with their 86% ownership sold $4 billion in the last year, bought twice as much in the same time frame, bought a lot more in comparison to selling in Q3, and the reverse of the trend, well, you'd have to go Q1 2024. Now, our intrinsic value, $183, is purely the average of the 3 models that you see on screen. If you solely wanted to focus on a discounted cash flow valuation, it would come higher at $203. We've used a growth rate of 8% moving forwards. Baked in today, for those interested, is 6% over the longer term. Again, may give you an indication of where you see this valuation, but using all 3 on average does give rise to a 6% margin of safety. Wall Street themselves see 22% upside into next year, $210 price target, and if you wanted a higher target for MOS at 10%, a buy at 165, at 20%, a buy at 146, and at 25, $137. Let us know your views on stock number 2, Waste Connections. And then we move on to Ferrari, down 17% in the last year. Year to date down 6%, trading very near to its 52-week lows. Huge pullback from 52-week high, over $500, where we get a strong sell from Quant. Another double buy from Seeking Alpha and Wall Street. Wall Street again very near to the strong buy rating, and this one on a forward valuation is trading around 38, which does look very high. And if we wanted to see, this one has traded around those levels in the last 5 years. Notably, 2019 was the lowest in the decade valuation, around the 21 mark, and it is trading at a 119% premium to the sector, but actually at a 18% discount to their 5-year, which is fairly rare to see. Price to earnings growth, though, does look high at 4, above the sector, but more importantly, trading at an 18% premium to their historical. And we note $4 billion worth of selling in the last year, 4 times in terms of the buys, so definitely strong net buyers. A little bit indifferent when we look at Q3. A lot of buying going on in Q2, and the reverse of the trend where you would in fact have to go to Q4 2022. In our intrinsic price, $394, well, we'll first flag that we have used a growth rate of 15%. That is the lower end we've highlighted, and because of that, in fact, no disparity between intrinsic and market value. That means today, for race or Ferrari, 15% is baked in moving forwards, which ultimately means if you're buying and you believe 15% growth to be reasonable, there is no margin of safety. It is, in essence, its intrinsic price. If you believe that, well, at 10%, a buy at 354, at 20%, a buy at 315, and at 25%, a buy at 295. Wall Street themselves see $510 into next year. That is 29% upside, so they are clearly very bullish. As we pinpointed, a near strong buy rating. And if you believe we are using a low amount, 15%, it should be higher. Well, at 20% at the middle rate, you are in fact getting a 30% margin of safety. But let us know your views today on Ferrari stock. We then move on to Zoetis, battered down 25% in the last year, losing a quarter of their market cap. Year to date, also down around 12%. Over the last 10 years, they've still managed to outperform the S&P, although we will say all-time highs, you have to go to December 2021 at $244, trading pretty much at 52-week lows, 52-week high, 193, with another double buy from Seeking Alpha Wall Street. Quant this time, unlike the previous two, not a sell rating, but in fact a hold, where their forward PE sits at least from this data set at a 5-year low, 22 versus historical 31. 2022, it was trading at a forward valuation of 50, where the yield of 1.4 does sit above historical 0.9, and we notice pretty much for the last year this one has been trading in a severely undervalued signal. Not once, unless you go pretty much to October 2024, was it in a reasonable value, and over the last 5 years you can see this one pretty much has been trading, for the most part at least, at a discount to the market overall, where the gap has widened from the beginning of the year. That is always a good sign. Stock price coming down, but intrinsic price increasing, great to see. And the grading comes in at a D, 21% premium to the sector, 33% discount to their own 5-year average. Price to earnings growth, 2.64. Yes, a premium to the sector of 41%, but actually a 17% discount to their historical 3.2. And institutions with their 93% ownership sold $10 billion in the last year, buying 50% more. They bought 3 times as much in Q3, so definitely a lot more bullish. Reverse of the trend, you would have to go to Q1 2024. Now our intrinsic price, $196, although DCF coming lower at 178. We've used 12% moving forwards, reverse basis 9.2, just in the last 2 years, strong double-digit growth. But using the DDM as well, we get a 27% margin of safety. Wall Street themselves, $190 into next year, 32% upside. Let us know, is Zoetis, in your opinion, a buy, hold, or complete avoid? We then move on to Comcast, down 30% in the last year, down 21% year to date. Over the last 10 years, the first one that actually hasn't performed that great at all, down 5%. So if you invested 10 years ago today, $10,000, without reinvesting those dividends, you'd be sitting on less, $9,500. In fact, all-time highs, August 2021 at $62. It's now trading less than half than that, and we can note pretty much also today at a 52-week low. Huge pullback from 52-week high, $45. Nonetheless, double buy from Seeking Alpha and Wall Street, where we also see a 5-year forward valuation low, 7 versus historical 10.5. Yield 4.5%, historically much lower at 2.8. Also the highest on offer to investors in this period. And you're probably not surprised then to see that severe undervaluation, something that's only been getting faster and faster in terms of disparity in 2025. But also note, the intrinsic price has also started to dip. Zooming out the last 5 years, in fact, not the best of look, with the expected price pretty much staying within the same boundary, but the share price itself has been dropping at a much faster rate. Now valuation, it gets a B+, 50% discount to the sector, 44% discount to their 5-year. Price to earnings growth at a 2, 30% premium to the sector, 66% premium to their historical, meaning they're not growing at a great rate whatsoever. And institutions with their 84% ownership selling $11 billion, they bought twice as much in the same time frame, but they actually sold twice as much in Q3. If you want to see more selling again than buying, you'd go to Q3 2024. In our intrinsic value, the average of the four coming to $40.50. As always, you can grab a copy of this model by clicking on the pinned comment below, where you're getting a 26% margin of safety. Wall Street pretty much see our intrinsic price into 2026. That is notably 35% upside, with the company paying a yield of 4.5%. If you just wanted to make note though, at a 30% MOS, it would be a buy around $28. So let us know your thoughts on Comcast today. And then we move on to Chipotle, down 29% in the last year, 31% year to date. Over the last end, still managed to outperform the market, up 222, trading not too dissimilar from its 52-week lows, quite a huge way away from 52-week an all-time high at $67. Seeing Alpha with a very weak buy rating, 3.5, would flip this into a buy, which it is. Wall Street 4.41, very near a strong buy rating, and they're trading at a valuation which is in fact the lowest going all the way back to 2019. And they do get a D- overall, 100% premium to the sector, but 39% discount to their 5-year. Price to earnings growth may be looking a little bit appealing at 2.1, 24% premium to the sector, but 13% discount to their historical, and quite high institutional ownership, 91%, $7 billion worth of selling, near enough double the amount of buying, but like we saw with the previous company, in the more recent quarter, twice as much selling. If you wanted the reverse of the trend, well, in fact, you note Q1 2024. In our intrinsic price, $49 from the DCF is using a growth rate of 15%. Again, the lower end, but just take stock that 23 and 24 was high double digit. Baked in today is 12.9%. So if you're using the lower rate, you are getting a 14% margin of safety. At 20, well, a buy at $39. At 25, $37. If you want to see Wall Street, their views, well, near strong buy rating, $55 into next year. That is 31% upside. And if you want to be a lot more optimistic, at the middle rate of 20%, well, we're talking 40% margin of safety. Chipotle Mexican Grill, is it a buy, hold, or avoid? And then we move on to APD, Air Products and Chemicals, down 23% in the last year, down 13% year to date. Over the last 10 years, up 81%, trading pretty much at 52-week lows, with a double buy from Seeking Alpha and Wall Street, where a forward PE sits just below 20, historically around 23.5, yield 2.8, little bit above historical 2.4, and we get that undervaluation signal, although only noticed one other time in the last year during Liberation Day. Zooming out to the last 5 years though, we can see this company has had some stretch where it was trading undervalued, but likewise in the 5-year period, also at a premium from 2021 to 2022. Now grading C-, 28% premium to the sector, 17% discount to the historical. Price to earnings growth though around 3, 120% premium to the sector, 16% premium to their average. And institutions with their 82% ownership selling $6 billion, bought a lot more in the last year at $14 billion, but they did sell quite a bit more in Q3. If you want to see another quarter where they did sell more, well, you'd have to go to Q3 2023. Now, our intrinsic price, $324, the average of the two, does give rise to a margin of safety of 22%. If you wanted 25, a buy at 243. If you wanted 30, a buy at 227. Wall Street, they like this, similar to the previous companies, with some nice upside into next year, $327. That is 29%. So let us know your view on APD. Is it a buy, hold, or sell, similar to the previous 6 stocks today? And don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.